Okay, so today let's continue our discussion of earnings per share. And we get this start. We got started the last class, so then we'll just continue. So let's start with this, the definition of the earning per share, the basic calculation. The numerator, we have income available to common shareholders. As we said, when we talk about the earning per share, we are talking about earning per common share, right? The residual ownership. And so on the bottom would be the number of shares outstanding. Now, what do we exactly mean by income available to common shareholders? What is exactly the common shares outstanding? So that's the first thing we're going to talk about. Now, because there are different groups of sources that contributed to the company's resources, and the earnings from the resources should be distributed among various parties that contributed their financing. So we have to subtract all the earnings belongs to the other groups. What's left will be earnings available to common shareholders. Okay, so that's the first part. And on the bottom, the number of shares outstanding fluctuates, right? The number may change. New issue can happen anytime, and it could be repurchase of shares, and it could be stock dividend, could it be stock split, all that situations. So what we need is a weighted average number of shares outstanding. So take an average, take a consideration of the length of various levels of shares outstanding throughout the year. So that's a two thing. So let's just look at the numerator for a through an example. So here we have example says Michael Limited net income is $3 million, and they have two classes of preferred shares. And so given that, what would be the income available to common shares? So class A is cumulative. Okay, so the dividend, so we know that in Canada now, like most shares has no par value. So when you see these $4, this we spell it out here. They tell you that $4 is the dividend, right? But if like sometimes companies don't really spell it out, just as $4. Class A preferred shares, 100 shares issued and outstanding. That $4 is not par value, rather it's the dividend. Okay, and then they have class B, which is non-cumulative shares, and the dividend is $3 per share, and also 100,000 outstanding. So let's first assume if there's no dividend declared or paid in the current year. Okay, and then we will change this condition here just to see like what the significance of that. So let's first assume there is no dividend declared and paid during the current year. Now we know for cumulative preferred shares, this dividend will become dividend in arrears and carried forward. So class A preferred shareholders will get this dividend before common share gets any dividends. That's what the cumulative means, right? If it's not paid, it will be accumulated. Class B preferred share, on the other hand, is non-cumulative. So that means if company does not declare and pay dividend this year, the class B shareholders will not get dividend this year. Next year, if Michael Limited declared dividend, they will get their $3 per share, but they will not get the $3 from this year because it's non-cumulative. If it's not declared, then it's lost for these shareholders. So that's the first. So therefore, if no dividends are declared or paid in the current year, so this is the computation. This is how we compute earnings available to common shareholders. Okay, so we subtract Class A's preferred dividend, but we do not subtract Class B's preferred dividend. Because since it's not declared, company doesn't have to pay. The company doesn't have to pay for this year, doesn't have to pay for ever. That's it, right? So the remainders will go to the common share. So now what if that's if preferred dividends are declared and paid in full for the current year, we change the assumption. If preferred dividends are declared and paid in full for the current year, however, then our calculation will be different. We will have to subtract both preferred and both classes of preferred dividend, because both class shareholders will be entitled to the dividend. One is $4 per share, one is $3 per share. So what's left would be $2,300,000. Okay, so I will summarize here in general. Now, what if the company have dividends in arrears? What to say if company has not paid a dividend for 3 years? And this year, it paid all the dividends in arrears, including current year's dividend. So let's do it as a third situation. If preferred dividends have not been paid for 3 years, and are declared and paid in full in the current year, I would say including dividends, including dividends in arrears in the current year. So if the company has not paid a dividend for 3 years, and paid up all the dividends in arrears, including current year's dividends. So it will have to pay 4 years Class A preferred dividend and 1 year Class B preferred dividend, right? Because Class A is cumulative, so all previous 3 years, dividend will be dividend in arrears. So in current year, there will be 3 years dividends in arrears. 3 years dividends in arrears. And same situation as the Class B, except Class B does not get dividend in arrears. It's not cumulative. So that means in current year, that would be the company will pay 4 years annual preferred dividend to Class A, 1 year to Class B. How much do we subtract to determine earnings available to common though? Do we need to subtract here like 4 times? Yes, like over here, 4 times. That's 3 years in arrears, 1 year for current. Now, what happened previous year? When there were no dividend declared and paid, what did we do? We already subtracted, right? Because we argued since this is cumulative, regardless if it's declared or paid or not, we should subtract a cumulative preferred dividends. So from calculating earnings per share's perspective, there's no in arrears. We already subtracted in previous years. So therefore, we don't do that. We still subtract 1 year. Does that make sense? Okay. So yes.
So, we would have subtracted, even though there is payable.
There's no payable. Like it's not entry. It's not entry. Yeah, so this is the presentation at the end of the income statement, right? Yeah, so they will be recorded when declared. So the journal entry would be actually debited preferred dividends for 4 years and credited dividends payable for 4 years. That's a journal entry, but not for this calculation of earnings per share. Does that make sense? Yes. So to sum it up, it's basically if the preferred shares is cumulative, you subtract 1 year dividend regardless it's declared or not. Even if declared not in full, you still subtract the full years, right? Because they're entitled full years. One, they get paid is another story, but they're entitled to it. If the preferred share is non-cumulative, you only deduct the preferred dividend that's actually declared. So that's pretty much sum up whole thing. Okay, so that's on the numerator. On the denominator, the weighted average number of shares outstanding is used. So the weighted average number of shares outstanding is weighted by the period of time they were outstanding. Okay, so you kind of each time the number of shares outstanding changes, that's a new period. And the next time something happens, such as issue of new shares, reacquisition of shares outstanding, retirement of shares, or like a stock split, each time things like that happen, number of shares outstanding changes. And then that's another period within the year. The length of that period would be the weight. So here's an example. You know what? I would like to go through these more complex example first. Let's do this example. This example has everything. So we'll just do this, like do this. Okay, so assume this company start out the year with 100,000 shares outstanding. And on March 1st, they issued 20,000 shares. So for January and February, that's a 2-month period, the number of shares outstanding is 100,000, right? Yeah, and then so the weight for that is 2/12 because that's the fraction of the year. And for March 1st, the number of shares outstanding changed to 120,000 shares. And stay that way until June 1st, they had a 50% stock dividend, okay? 50% stock dividend. And so therefore, the number of shares changed on June 1st. So March, April, May, that's 3 months. The number of shares outstanding is 120,000. And that 120,000, the weight is 3/12. So that's it. And then they have a stock dividend. So this 50% stock dividend would be treated, if you recall to the chapter we talk about the shareholders' equity, this will be large stock dividend. The accounting for large stock dividend will be very similar to stock split, right? Yeah, so it's like almost like a mini split here. So that additional 60,000 shares were issued. Screwed up. Additional 60,000 shares were issued. And so the state, so that will be 180,000 shares. And then on November 1st, they issued a further 30,000 shares. That's all increased. So on November 1st, the number of shares outstanding changed to 210. And so it's the June, July, August, September, October. So that 5 months, you have 180,000. So that 5/12 is the weight, right? So by the end of the year, the number of shares outstanding is 220. And that's for 2 months from November 1st to December 31st. So that's the story. And to calculate weighted average number of shares outstanding. So as I said, we divide, actually, this is not the truth, that this will be more accurate is January, February, because it changed March 1st, right? So if you just roughly count by month, it should be January, February, and then March, actually it should be March to May, because they changed in June 1st. The full month would be March, April, May. And the June to November 1st, but the full counting full month, it should be June to October 1st, October 31st, because November 1st things changed, right? So that, however, the number of months we're counting here is correct, right? So the first level, when it's $100,000, that's stay that long, the period is 2 months, so the weight is 2/12, that's fraction of the year. And then for March to May, that's 3 months at 120. Now, stock split and the large stock dividend kind of thing, it kind of changes the nature of the shares, right? Say you have a stock split. Now almost like you have smaller new shares. 2 new shares are equivalent to 1 old shares, right? So on May 1st here, you almost like get into a new era. Now we're counting with the new smaller shares. Before that, the number of shares, each share is like 1.5 of new shares. So for stock split and the stock dividend, not only we adjust number of shares outstanding, like we did here, we add 60,000 shares, that's 50% more than before. We also restate the periods before that. So to convert these old shares into equivalent new shares, right? So for these two periods, if you see only these two periods, we have this readjustment, restatement. Okay, but because June 1st is the day that stock split happened, or they call it stock dividend happened. And from then on, we count in new shares, which is each share equals to 1.5 old shares. And then to make sure before and after June 1st, we're talking in the same terms, we go back to adjust all the old shares by multiplying this 1.5. Okay. These shares times the fraction of a year is weighted shares. And so when you add all the weighted shares, you have the weighted average shares outstanding throughout the year.
What about situations where you buy back shares?
What happens to the number of shares outstanding when shares are bought back? We just subtract.
Would we have to do a restatement?
No, you do not do the restatement. You just, the buyback shares is almost mirror image to issuance of shares. Okay, and the stock split can be like a 2-for-1 split, can be 1-for-2 split, right? So that's the mirror image. If 2-for-1 split, you go back to adjust it by multiply by 2. But if it's 1-for-2 split, you go back to adjust multiply everything by 0.5. So that's the reverse. Okay. So that's the number of shares. So so that now you get the denominator for basic earning per shares. That's what we need to do. On the numerator, we determine earnings available to common. On the denominator, we determine to weighted average number of shares. I'm just going to sidestep for 1 more second. So what about the earnings attributable to non-controlling interest? Should that be included or should that be not included? And how does it reflect on our computation we just went over?
You know, we just disclosed it.
Sorry?
Remote, for the phones, we just disclosed it.
We excluded. Is that what you're saying? No, you're disclosing. Yes, it's not just disclosed, it's reported. It's actually recognized, it's on the, but I'm saying when I calculate earning per share, do I need to do anything about it? When in doubt, go back to the basics, right? We're talking about the earnings per common share. So does earnings attributable to non-controlling interest belongs to common shares holder? No, no. So how does it fit in our calculation? This is how it fits in the calculation. This example, right? This income is the income attributable to the shareholders. This is not like the earnings attributable to non-controlling interest is already excluded. Does that make sense? Because like the bottom line, or like we keep saying bottom line is net income. Now the bottom line, you look at the income statement, it's in the middle of the statement. Because after bottom line, you have out of that net income, This part goes to the shareholders. This part goes to the non-controlling interest, right? So we take that part of the income goes to the shareholders. That's what it is. Okay, so it's not included, and we take care of that. This is like a net income excluding non-controlling interest. These will be the earning belongs to shareholder to begin with. Okay, does that make sense? Yeah, things like that, like kind of almost gnaws you at the edges, like you kind of like you don't want to talk about it. It's not that important, but you know, but it's good that we know what it is. We know where it, belongs. We know like how to fit in the picture. That's so much better, isn't it? Okay, so that's about basic earning per share. So I'm jumping back and forth, but I think that's a little better. So now we saw in some companies, now in addition to have a basic earning per share, they also have a diluted earning per share. And diluting earning per share is required when company has what we call the complex capital structure. You only need a basic earning per share if you have a simple capital structure. So the difference between simple capital structure and complex capital structure is that sometimes there are such securities that represent potential shares. Okay, so for instance, convertible debt or convertible preferred shares or stock options, warrants. So these are securities that give the holders rights. And if they decide to use those rights, the company will have to issue more shares. Okay, so in that case, we have a situation, you have actual common shares outstanding, but you also have these potential shares that may be issued and outstanding. So in that situation, company need to calculate two earnings per share. One is basic earnings per share based on actual earnings and actual number of issued common shares that are outstanding. And the diluted earning per share is based on the potential. Okay, earnings and the number of common shares adjusted for what if the potential, right? If these potentially dilutive securities are exercised, converted. So that's that. Okay, so having said that, I'm jumping back and forth. So because I want to, okay. Right, so that way, simple capital structure, you only have preferred and common shares, and you just report basic earning per shares, that's good. Complex capital structure, you have potentially dilutive securities, you need to present basic and diluted earnings per shares. Okay, so, I keep repeating these. Okay, so here are the complex capital structure means basically company, in addition to common and preferred shares, it also have two types of securities. One is convertibles, one is options and warrants. And the way to deal with these two groups of potential shares, this potentially dilutive securities are different. So that's how we group them. Convertible bonds, convertible preferred shares are all used if converted methods, whereas options and the warrants and other rights are used treasury stock method. And so that's the two different. Okay, so diluted earning per share if securities potentially convertible into common shares are converted, and then we will have to use, what if approach. If they were converted, if they were exercised, how the earnings available to common will be affected, and how the average number of shares outstanding will be affected. Now, there's one thing we need to remember, that diluted earning per share cannot be more than basic earning per share. It is possible when some of these potentially dilutive securities, when you include them in computation of common shares earning per share goes up. And if that happens, we say this security is anti-dilutive, and they should be excluded. They should be excluded. So so only if a potentially dilutive security is actually dilutive, we include it. Okay. Okay, we talk about, let's look at the example. Yes, that's it. Before we look at the example, we just talk about the method. So as we said, there was two classes of potentially dilutive securities. One is the group that's all convertibles. And the method we use is called the if converted method. And we assume the conversion, imagine the conversion happened either at the beginning of the year, or if these securities were not outstanding at the beginning of the year, they were issued during the year, then it will be as soon as it's issued. So the earliest possible date. The dilutive effect of options of warrants, there's a second group of potentially dilutive security, is measured by the treasury stock method. Explained later. For computing the dilution, the rate of conversion most advantageous to the security holder is used. So that means we want the diluted earning per share represent the maximum dilution caused by these potential shares. Okay, maximum dilution. So here is an example of that. So net income is 410,000. Common shares outstanding during the period is $100,000. Additional securities outstanding, we have 6% convertible debenture bonds sold at 100 for $1 million, convertible to 20,000 common shares. And we have 10% convertible debenture bonds sold at 100 for $500,000, convertible to 32,000 common shares issued April 1st of the current year. So one outstanding the entire year, one outstanding 3/4 of the year, and that should matters. And then we are given a tax rate of 30%. Why do we need that? Okay. This is why we did that. What happens if we assume these bonds were converted either from the beginning of the year or as soon as they were issued? If they were converted, two things happen. One, there will be more shares outstanding. So that's impact on denominator. Two, the company will not have paid dividend. If there are no bonds outstanding, they will convert it into common shares, then there will be no need to pay dividend. Sorry, did I say dividend? No need to pay interest. No need to pay interest. And if there's no need to pay interest, the numerator will be affected. Because in calculating basic earning per share, the interest and preferred dividend are all subtracted, right? We didn't subtract the interest. Well, we didn't, but we did because we started with net income. And the net income is computed after all expenses are subtracted, including interest, right? So yes, so that's the two impact. Okay, so here it shows the numerator. No, here it shows the denominator. So the weighted average number of shares, that's a common, that's the actual shares, 100,000, that's given. We skipped the slide, I think. No, that's to just look at this. This is the denominator. That's the given. And 6% convertible bonds can be converted into 220 shares, 20,000 shares. So I put it here. So that's a 6% debenture. And 10% debenture can be converted to 32 shares. However, that's 32 shares outstanding from April 1st to December 31st, only 9 months of the year. So we apply this fraction of the year, just like we calculate weighted average number of shares outstanding. So the weighted average shares for this debenture would be 24,000. So applying if converted method, the number of shares outstanding will become 144. Okay, so that's the denominator. Applying if converted method, denominator becomes 144,000. And this numerator is the net income. Now, if no debentures outstanding, there will be no interest. So we will just the interest on the 6% debenture is 6% on $1 million. So that's $60,000. A little twist here, interest is tax deductible, right? So if there's no interest, the tax will be higher. So the adjustment should be we add back after tax interest. Okay, does that make sense? Yeah, so because if there is no interest, income before tax will increase by 60,000, but the income tax expense will increase. So by the 30% of 60,000, 18,000 as well. So the net impact on the earnings available to common share should be 42,000. So that's, you know, the saving of interest expense 60,000, but there is additional 18,000 income tax now on it. So the net impact is this. Now, if this is not convertible debenture, if this is convertible preferred shares, we don't need to worry about tax. And if it's convertible preferred shares, right? Because preferred dividend, that's already after tax figure. Yeah, so that's only you need to make adjustment for the tax if we're talking about the interest. And for the 10% debenture, the interest for the year is 50,000, 10% on, why did I have 15,000? Oh, yes, because it's on 500,000 face amount. So the interest before tax interest for the year is 50,000. In this case, we need to adjust for two things. We need to adjust for the income tax, and we also need to adjust for. Is there a question? No, I don't think so. And we need to adjust for the fact that it's only, the company would only have to pay 9-month interest, even if, you know, right? So a fraction of the year. So therefore, the net interest is 26 to 250. So the adjusted net income is 478 to 50. So the numerator is 478 to 50 and the denominator is 144. So here it is. The basic earning per share is a $4.10 and diluted earning per share is based on adjusted numerator and adjusted denominator is $3.32. So diluted earning per share is less. Okay, so this is about the convertibles. And the next thing is about the option and the warrants. Okay, so the textbook talk about the option warrants issued by the company, and the options warrants are like whether company writes options or sells options. So we just focus on the we sold the option for the holders to purchase additional shares. We do not look at the put option, so we have to buy shares kind of situation. We just look at the one situation, right? So now the option, a written call option, that's the example we focus. If these options are exercised, so what actually happened, what actually would have happened would be company will have to issue more shares. And the company will receive cash payment and issue more shares at the option price, right? At the exercise price of the option. Okay, so that's what actually would have happened. You know, you will receive the exercise price and issue new shares. But the treasury method assumes the company would then use the proceeds from the exercise of the options to purchase back as many shares as possible. Use all the proceeds to purchase shares for treasury. So two things happen. The exercise the option increased number of shares outstanding. The repurchase decreased the number of shares outstanding. So the treasury method is the impact, the net impact of stock option or warrants would be the net increase in the common share, assuming shares increased when options and the warrants are exercised, but decreased when the proceeds are used to repurchase shares. And so whatever the difference between two is the net increase of the shares outstanding. Now, if you think a little bit about it, you go, what if you end up buy back more shares than the shares issued? Then wouldn't it end up decrease the number of shares outstanding? Wouldn't that be anti-dilutive? In theory, might be, but in reality, it doesn't happen. Because if you could buy back more shares with the proceeds, that means those options and the warrants are out of money. And no rational person would exercise the options warrants when they're out of money, right? So we don't have to worry about that situation, that the number of shares, the net changes in shares would always be increase in shares. Okay, here's an example. Say the exercise price of an option is $30. So that's the exercise price is the price we use to calculate the proceeds that you might receive if these options are exercised. And then when you purchase shares, for treasury, you use the average price of the year. So they should be given to you as an average price of the year. Okay. So this one is a market price of one share at exercise date is 50. Now, it's actually should not be that the price of that day that actually, because this is not actually exercise, right? This is actually like we assume it's exercise. So we should use the average price of that stock during the year. So let's just assume that's what it meant, $50. And say there are 15,000 exercise, 15,000 exercise. This is the treasury stock method to record the actual exercise of the option. And keep in mind, when we compute the diluted earnings per share, the options are not actually exercised. So those are assumed transactions. So there's no exercise date. And we assume, there's no exercise date. We assume that exercise is the very beginning. So you impact the number of shares outstanding for the whole year, right? So we use exercise price and the average share price. So the computation is here. The proceeds from exercise would be at $30 per option, 1,500 options. So the total proceeds will be $45,000. And then that's the proceeds. The shares issued upon exercise option is 1,500 shares. And the treasury shares purchased with the proceeds, so that's that $45,000 divided by $50. That's, we assume like how much you have to pay to buy back shares, and you can buy back 900 shares. And so therefore the incremental shares outstanding is 600. Okay, so all that computation, the only number that will actually we really want to get to is this number, because this is the number will be added to the denominator. Options and the warrants does not affect numerator, right? It's a financing activity transaction. There's no gains and losses recognized, so it doesn't affect numerator, only affect denominator. And if we assume out of money options will not be exercised, so the only impact will decrease the earning per shares, because there's always a positive incremental shares outstanding. It may be zero, but it cannot be negative. Okay, so that's that. Anti-dilution. So as we said, it's possible, so we have to deal with the situation, right? So this is the example of what might happen when there's anti-dilution. So it's say the company has 1 million in 6% convertible debt, convertible to 10,000 shares, and the net income is 210 shares, and there's like 100,000 common shares outstanding, tax-free to 30%. So the basic earning per shares is $2.10. Okay, $2.10. And so this is, you have a complex capital structure because you have a convertible debt here. So that's a potential dilutive security. So that's make it a complex capital structure. So to determine diluted earning per share, the numerator will be affected by the after-tax interest, right? So use if a converted method, we will assume that the 1 million debt is converted from the beginning of the year. So that will save company 6% interest, adjust for income tax, that would mean 42,000 after tax interest would be avoided. So the earnings will become 252,000. Okay, and the denominator, if these were converted from the beginning of the period, number of shares outstanding will increase by 10,000. So we will have 110,000 as denominator. And so if you do the calculation, the basic earning per share is $2.10 based on $210,000 earnings available divided by 100 shares outstanding. Diluted earning per share based on adjusted earnings available to common, that's 252, and adjusted number of shares outstanding, that's 110,000, is $2.29. So that means this convertible debt is anti-dilutive. Now, what do you do? How do you report? You still have to report diluted earning per share. As long as you have a complex financial capital structure, you need to do that. So, but what you will show is you will have basic earning per share, $2.10, diluted earning per share, also $2.10, that they will be the same. Okay, there's still dilute. So diluted earning per share is $2.10. Okay, we know it's dilutive. Okay, we know it's dilutive because we calculate both earning per shares, right? We calculate the basic earning per share without that convertible debt, and then we calculate the earning per shares again with the convertible debt is included using the if converted method. So we go, well, the earnings per share went up, that's anti-dilutive. There is another way to test it, and this is very important because when you have multiple potentially dilutive securities, some may be dilutive, some may be not, right? Some may be dilutive, some may be not. And it will be good if we have a systematic way to test them. And so in order to apply that systematic approach to say we have like a bunch of potentially dilutive security, how do we know which is dilutive should be included, which is not dilutive should be excluded? We need to test the dilutiveness of each one. And so this second shows the the second one shows that the test for the individual potential dilutive securities, right? So just focus on this convertible debt. If the convertible debt is converted, you would adjust numerator by 42,000. If the dilutive, the convertible debt is converted, you will adjust the denominator by 10,000. So basically what you have here is, let me put it here. I will just not what I want. Okay. I want to write something, so I'll use a text box. There it is already. Just writing here. Okay, so incremental earnings per share, we'll just focus on that. Incremental of convertible debt is 42,000 divided by 10,000. And that is $4.10. Okay, so I do not need to add this to the earnings. I do not need to add the shares to the number of common shares outstanding. I just look at the impact on the earnings and the impact on the number of shares. And if this is more than 2.10, that's a basic earning per shares, then, you know, we know it's anti-dilutive, right? And in fact, if you have multiple potentially dilutive security and you calculate the incremental earning per share of each of these potentially dilutive security, you can tell which is dilutive, which is not dilutive. Not only that, you can also tell the degree of dilutiveness, which is more dilutive, which is less dilutive, and which is not dilutive at all. Okay, so that's the base for our computation of a complex comprehensive problem. Okay, so there are like these steps. If we follow, we will always be able to get to the maximum dilutive earning per shares. So first you compute basic earning per shares. And so you have like earnings available for common, and you have weighted average of common shares, because that could be complex as well. And then you compute incremental earning per shares for each potentially dilutive security, just like we did for that convertible bond. What is the incremental earning per shares for options and warrants? What would be the incremental earning per share for options and warrants? Zero, right? So that will be always the most dilutive, right? As you know, it's rank potential dilutive securities from the most dilutive to the least dilutive. So basically, the smaller the incremental earning per share will be the more dilutive of that security. So options and warrants are always the most dilutive because they have zero incremental earning per share. Make sense? So then you just keep going up in the order. Compute diluted earning per share by adding one potentially dilutive security at a time, according to the ranking. So you start out with the basic earning per share. If you have 5 potentially dilutive securities, You calculate all the incremental earning per share for each one of them, rank them from 1 to 5. Okay, so you start the step 4 means you start with the basic earning per share and you add number 1 dilutive earning per share. Number 1 potentially dilutive securities. And then you compute a diluted earning per share. So this, if it's dilutive, that should be less. Now, then you add number 2. So you see, as you keep adding, that your earning per share is already less than basic earning per share, right? And then you keep adding it. Each time you added, the diluted earning per share will change. It could go down, could go up. As soon as it stops going down, you stop. That means all the rest are anti-dilutive. So that's how you go. You go by the rank and you look at how that affects your earning per share. If the earning per share decrease as a result of including 1, that's fine, keep going. As soon as the earning per share stops going down, started going up, you know that stop, because that's where that's the maximum diluted earning per share. And if you include more, the earning per share will be less diluted. And so all the ones ranked below that will be anti-dilutive. And they will not be included in your computation of earnings per share. Okay, so that's, you know, I think I'm going to stop here today because it's a good, we covered everything. Everything we need to know. There's a lot more details in the textbook, and like we don't need to exhaust all the all those details. So all we need to know is the basic earning per share. We need to consider the you know, what do we need to adjust to get the earnings available for common on the numerator, and how to compute the average number of shares outstanding for the denominator. That's good. And when you have a complex capital structure, we look at the convertibles, that's one group, and we have that options and warrants. For convertibles, we use if converted method. For option and warrants, we only focus one type of options, that is sold call options. And there are sold the put options. We don't worry about that, just sold options, sold call options. And we use treasury stock method. Okay, and then so that's we use that in order to determine diluted earning per share. When you have multiple potentially dilutive earning per shares, we need to use that if converted or treasury stock method to compute the incremental impact of each potentially dilutive securities to compute incremental earnings per share, and then rank them and include them one by one according to their rank. And so your earning per share would go like, you know, possibly go like that, or possibly just go like that, you know. But so you want by doing this way systematically, you will be able to find that bottom. Okay, so next class we will do a comprehensive example on that. So I think this is good for us. I'll stop a little early today. I think always we talked about the SB is pretty silent about the earning per shares. Okay, so it's the IFRS have you'd have to disclose earning per shares, and you have to disclose both basic and diluted earning per shares. On top of that, if you have major earning segments, you have to disclose earning per shares for major earning segments. So for instance, if you have discontinued operation, you have to calculate earning per share for that segment. Okay, so that's all for today. Any questions?
Thursday. That's a holiday, Thursday.
We have a holiday this Thursday?
Yeah.
Oh, okay.
So I don't know if you want to pre-record.
What do I want to what?
Are you gonna pre-record?
No, holiday, you guys have holiday. I think you're right. There's a holiday, but I think it's in the outline. I just forgot here. Yeah. You get a holiday. Okay. All right. Well, have a good holiday then. Did I not release the quiz marks? Okay, will be done today.